Okay, so imagine this. You're in Tokyo, it's Friday morning, you're getting your coffee and maybe like a melon pan on the side, and you look at the Nikkei and it's not good. It's
Yeah.
like someone just took a stack of pancakes and just shoved them, you know?
Mm.
It's a big drop, and we're seeing these drops across Asian markets, and the reason is pretty familiar, I think, a familiar figure, and his playbook, President Trump. He's back in the White House, and tariffs are back too, especially tariffs aimed at China.
Yeah, what's striking is how quickly the markets reacted. Japan's Nikkei initially dropped over 5%, and it ended up settling around a 4.7% loss, so that puts it near 33,000. And South Korea's Kospi and Australia's S&P ASX 200 are also down.
Yeah.
It really shows you how interconnected global markets are and how sensitive they are to even the hint of trade wars.
Yeah, for sure. And it's not just stocks that are reacting. The currency markets are moving too. The Japanese yen is getting stronger against the US dollar, which is like investors running to safety, and the euro is also gaining on the dollar. It's like the whole financial world is adjusting itself because of these trade tensions. So today we really want to understand what's behind this whole tariff tango, as some are calling it, and what it could mean for everyone, even if you don't spend all day watching the markets.
If we take a step back and look at the bigger picture, this whole thing shows a fundamental tension in the global economy. Think of the U.S. and China as these two huge players in the world's economic system. And when they disagree about something as basic as trade, in this case, tariffs on imports, it's going to create ripples that go way beyond their own borders.
Right. It
Yeah.
affects everyone. And what's really setting this off is President Trump's latest proposal, a possible 145% tariff on goods coming into the U.S. from China. Now, I know we heard a number closer to 125% on a social media a little while back, but it seems like this 145% number is the one that's sticking. And what's important is that it's on top of the tariffs that are already in place. So
Hmm.
it's not starting from scratch. It's a big escalation.
Yeah, you have to think about what a tariff like that would even do. A 145% increase isn't just some small change. It would completely change the economics of trade between these two big countries. It's not just a small price increase. It could reshape whole supply chains and how much things cost for consumers.
And China isn't just hitting back with tariffs of their own.
Hmm.
They're thinking about other, maybe more specific ways to respond. And this is where things get interesting. We're hearing that they might limit the number of U.S. films that can be shown in Chinese theaters. Talk about hitting major American entertainment companies where it hurts.
What's interesting about this move is how strategic it is. It's not just about how much money the movies make. It's also about cultural influence. It's a way of saying their response will go beyond just the economy.
And we're already seeing the impact on specific companies, Warner Bros. Discovery's stock dropped over 12% when this news came out. And when you think about how much of their money comes from international markets and how important China is to that, you can see why. Even Disney's stock dropped almost 7%. And the word from the China Film Administration is something like, if you put tariffs on our goods, we'll make sure your big movies fail here, which really shows what's at stake.
It highlights how connected things are, even industries that seem totally separate.
Yeah.
You wouldn't think Hollywood would be affected by tariffs on manufactured goods, but this shows how far the consequences can reach. It reminds us that in a global economy, actions in one area can have unexpected effects somewhere else.
Now, it's important to remember that this whole situation has been up and down. Just a couple of days ago, on Wednesday, April 8th, there was an announcement of a 90-day pause on more tariff increases for most countries, and the U.S. stock market actually went up quite a bit. The S&P 500 jumped 9.5%. It was like everyone breathed a sigh of relief, like maybe, just maybe, these trade tensions were easing up.
Yeah, that initial surge in the market really showed how much investors want to see things calm down in trade. They saw the 90-day pause as a good sign, a possible step toward a more stable trade environment.
But that feeling didn't last long. By Thursday, the White House clarified things and said that the proposed 145% tariff on Chinese goods was still happening. It's like in those cartoons when a character runs off a cliff and they hang in the air for a second before they realize they're falling.
Exactly. That clarification totally took away the market's earlier excitement. They realized that this huge tariff on China was still a threat, and investors changed their minds. It was a clear sign that the tensions were still there.
And the market reacted dramatically on Thursday. The S&P 500 dropped more than 3.5%. The Dow Jones Industrial Average lost over 1,000 points, which is a 2.5% drop. And the Nasdaq Composite fell even more, down over 4%. At one point, the S&P was actually down over 6%. It was a very quick and negative response to the threat of these high tariffs on China.
Those big drops in one day really show that the market thinks a trade war between the two biggest economies would be bad for the economy. The size of the drop shows how much risk they see to company profits and overall global economic growth.
So what's the strategy here? Was that initial pause just a tactic? Stephen Innes from SPI Asset Management said the champagne's flat, the party's over, which really captures how that short-lived optimism is gone. And then you have Trump's Treasury Secretary Scott Bessent with this message to other countries, don't retaliate and you'll be rewarded. It's like a warning, but also kind of a bribe.
It makes you wonder who these messages are really for and what they're trying to achieve. Is the goal to pressure China directly, or to tell other trading partners to side with the U.S.? Or maybe there are even domestic political reasons. The fact that it's not clear just makes the market more uncertain and volatile.
Meanwhile, China seems to be thinking beyond just direct retaliation. It seems like they're trying to build a group of countries that are also being hurt by these U.S. trade policies. It's like they want to create a united front, almost like the economic version of assembling a team of powerful allies to push back against the U.S.
This strategy of trying to get other countries on their side suggests that China knows they can't do it alone. They want to be stronger by joining with other countries that also have problems with these protectionist trade policies. It's like they're trying to change the whole global trade landscape through alliances.
Interestingly, the European Union is being more careful. On Thursday, they said they would pause their own plans to retaliate on trade for 90 days. The idea is to give them time to negotiate. It's like they're trying to be nice in the middle of a potential conflict. You admire the thought, but you wonder how much it will actually help.
The EU's decision shows how complicated global trade is. They're clearly trying to find a way to avoid making things worse, but also showing that they're ready to fight back if they have to. It's a tough balancing act because they have a lot of different economic interests and they want global trade to be stable.
Okay, let's talk about the bond market, which is often overlooked, but super important. U.S. Treasury yields have been really volatile lately. The 10-year yield, which is a key indicator, jumped from around 4% to almost 4.5% earlier this week, which really worried investors. Even President Trump said that yields were getting a little queasy. Then, after some inflation data came out, they calmed down a bit, but they've gone back up again. By Friday morning, they were around 4.39%. So what's causing all this movement?
Well, the volatility in Treasury yields is because of a few things happening at the same time. The uncertainty around trade policy can make big investors like hedge funds sell their Treasury holdings to get more cash. Also, foreign investors who own a lot of U.S. debt might not want to hold those bonds if they're worried about a trade war hurting the U.S. economy. When more people are selling bonds, the price goes down and the yield goes up. And higher Treasury yields affect everyone because they make it more expensive to borrow money for the government, for companies, and for people like you and me.
Right. Higher yields mean more expensive loans, and that can slow down the whole economy. And it's not just bonds that are reacting. Oil prices have also moved. We saw both U.S. benchmark crude and Brent crude, which is the international benchmark, drop a little. This is mostly because people are worried that a big trade war will slow down the global economy, and that would mean less demand for oil.
Yeah, the slight drop in oil prices shows that the market thinks there might be less economic activity because of all this trade tension. If businesses start being more careful about investing and consumers get worried about the economy, the demand for energy like oil goes down.
Let's go back to those possible restrictions on U.S. films in China for a second. This shows that the trade dispute isn't just about the economy, it's also about culture. It's a way for China to have power beyond just tariffs and trade.
Exactly. By maybe limiting American movies, China isn't just showing that they're unhappy, they're also potentially changing what people in China see and hear. It's what they call soft power in international relations.
So let's think about what all this means for you, the listener, in your everyday life. Basically, trade wars usually mean higher prices for a lot of the things you buy. Think about all the stuff you buy that's made in China or has parts from Asia. Tariffs make it more expensive to import those goods, and those extra costs often get passed on to you as higher prices. If you have investments in a 401k or mutual funds, you probably felt the impact of those big market drops we talked about, and those rising treasury yields. Well, over time, they can make interest rates on things like mortgages go up, which means it's more expensive to buy a house or refinance.
It's important for people to understand that these events that seem far away actually affect their own finances. From the prices of things you buy to how much money you make on your investments and how much it costs to borrow money, a big trade war can affect the whole economy, and that affects individuals and families directly.
Now we should try to stay calm in all of this. Financial markets can be unpredictable, and they sometimes overreact to news. That 90-day pause on more tariffs for most countries, even though it doesn't directly involve China, could still be a chance for the U.S. and its other trading partners to negotiate, and that could indirectly make the whole trade situation better. And China, trying to get other countries on their side, might actually put some pressure on the U.S. to change its trade policies. There's even the idea, though, it's hard to know for sure, that maybe President Trump has a more complicated strategy in mind.
Yeah, it's smart to not jump to conclusions, but it's also important to think about different reasons and possible outcomes to understand these complex global situations. The world of international politics and economics is full of different players, and they all have their own goals and strategies.
What we're seeing with these trade disputes is kind of like a drama playing out in real time. There are always new things happening, unexpected turns, and big disruptions to how things are made and how much they cost. Trade tensions aren't new, but the situation now feels more intense because of how big President Trump's proposed tariffs are and how quickly and strongly China is responding.
Yeah, it's good to remember the historical context. Trade disputes have always happened. But what's different now is that the U.S. and China are so big economically and so connected to the rest of the world that the consequences could be much bigger and last longer.
So, the main thing to remember is that this whole trade situation is very uncertain. The size of the tariffs and how fast the markets are reacting are definitely things to watch closely.
Right, because things are changing so fast. We need to keep an eye on a few key things. It's important to watch what happens during that 90-day tariff pause for other countries. The bond market, especially U.S. Treasury yields, will tell us how investors are feeling and how much it costs to borrow money. And whether China can get other countries to join them against U.S. trade policies could really change how future negotiations go.
Exactly. So, the best advice right now is to stay informed about what's happening, read the news from reliable sources, and don't make any rash decisions or panic. The markets go up and down. It's normal. And even though these events are a big deal, knowing what's going on and understanding the reasons behind it are always your best tools.
This brings us to our final thought for you. Think about how events that seem far away, like a tariff announcement on the other side of the world, can actually have a big impact on your life and your finances. Understanding these global connections is becoming more and more important in our world, where everything is so connected.